Let's move on to Chapter 8, which covers the efficient market hypothesis. And it's related to modern portfolio theory and also to the capital asset pricing model. So let's finish up this section on the asset pricing and asset valuation by taking a look at some of the details about the efficient market hypothesis and efficient capital markets. All right. So what is an informationally efficient market? All right. It is a market in which security prices adjust rapidly to reflect the infusion of new information. So it's new information, so a quick reaction by security prices, brand new information that comes into the market, and that information is different than what was expected. This is what moves security prices and what moves markets. New information that is different than what was expected. All right? Therefore, if you assume this, that markets are informationally efficient, then current security prices, you assume, fully reflect all available information, everything that's already out there that we know about the markets, about the issuers, and about the securities is already baked into, incorporated into current security prices. If this is true, then current security prices imply the expected returns that incorporate the expected growth rates. So the expected growth rates are already reflected in the valuation or the multiples of current securities, and the expected growth rates of sales, earnings, and cash flow, and the expected level of risk. So these are the things, growth rates and risk, are the major variables that drive valuations. And so when we look at valuations for securities, they are telling us what investors expect for growth and for risk. All right. These things, these actual items, let's go back. The growth rate of sales, earnings, and cash flow, and risk, these items change over time. Okay? So, as expectations change, stock prices change along with them. I am not saying that if you believe the market is efficient, which I do for the most part, I'm not saying that stock prices don't change. I'm saying that what drives the change in stock prices are changes in expectations for growth rates and risk. All right, so changes in variables do not make the stock market inefficient as long as current stock prices accurately reflect what we already know and what is expected for the future. The less we know, the less certain we are in terms of our expectations for a particular company, the more volatile that company will be, because the current price does not really reflect expectations because we don't have solid expectations. The more mature a company is, and the better the history is, the stronger we investors feel about the future growth rate and the risk level, and therefore these securities tend to move less than the securities of companies that we really don't know as well. All right? Prices will react rationally to changes in expectations. If changes improve, if changes increase, expectations increase, if expectations rise, the stock price and the valuation will rise. If expectations deteriorate, then the stock price and valuations will deteriorate. Okay? So what are three assumptions of an efficient capital market? First, that there are a large number of participants who are trying to maximize their profit. Okay? And they analyze and value securities independently of one another. So we're all out there looking at these securities, trying to figure out what a proper valuation is, and we are not colluding with one another. Okay? Two, we assume that new information regarding securities comes to the market in a random way. In other words, we can't predict it. We don't know what the news will be, and we don't know when the news will happen. Okay? You don't know when, and you don't know what. And then third, we assume that investors will adjust security prices rapidly to new information that changes expectations. Okay? The adjustments that happen to stock prices may not be perfect, they rarely are, but they are unbiased. It is our best guess. All right? So what are three forms of an efficient market? There are three forms. There's the weak form, the semi-strong form, and the strong form. So let's look at the weak form assumption about the stock market. Okay? The weak form assumes that current stock prices reflect all security market information, including historical prices, historical returns, and historical trading volume. So we have information about the market. Therefore, trading rules based on historic price, historic returns, or value patterns are of little value. In other words, using information about the past does not help us in terms of forecasting where we think stock prices will go. Lots of studies have been done of weak form efficient markets, and most people believe that the market is weak form efficient. Okay, which means that studying the past doesn't do a whole lot in terms of helping you predict the future. Now, there's some analysts out there called technical analysts that completely disagree with this. Okay?